Nigeria's Upstream Petroleum Regulatory Commission says the country has attracted $18.2 billion in investments through 28 approved field development plans driven by ongoing reforms in the sector. Meanwhile, Nigeria LNG is turning to third-party gas suppliers after a sharp decline in plant utilization. Oyeyemi Oke, a partner at AO2 Law, joins me now for more on these developments. Thank you so much for your time on the show today, Oyeyemi. Let's get to this story we're looking at here. It speaks volumes in terms of the attractiveness of the upstream sector in Nigeria. $18.2 billion in investment commitments so far. This sounds like a breakthrough, you would say.
Yes, it is. And I think it's also signaling confidence in the Nigerian petroleum industry. The reasons for this leap, right, in terms of commitments may not be unconnected with the fact that certain marginal field holders, right, have obligations, which we call the drill or drop obligations. If you recall, the marginal field process we started in, the award process we started in 2020 was completed between 2021 and 2022 with awards given in 2022. And under the various petroleum prospecting license term documents, what you have is that there must be a commitment of, there's a minimum financial commitment which must be done within the first 3 years of the award of the PPLs. If you look at 2022 to now, that's in 3 years, which is 2025. The rush for PPL holders to conform or to comply with the provisions of their licenses, there's a lot of rush, and that may have also, that may have also informed why we have significant commitment, apart from perhaps the major commitments from Bonga. So the financial commitments, as far as I'm concerned, is a step in the right direction, and also obviously there is a race in order for the marginal field PPL holders to comply. Else they would have to drop their licenses.
Yeah, but the big picture here basically is just to see our reserves unlocked and also boost production. You know, how's that journey looking like from here, especially with the 28 approved field development plans?
Yeah, so, you know, with the field development plans, there are plans essentially into the future. But I think the good thing about it is that obviously, if the plans have been submitted or have been approved by the commission, definitely the license holders have to abide with the provisions of the plan, except if there are any forms of exigencies. Now, what does this? Obviously, reserves will be developed, reserves will be increased. But for me, beyond even developing and increasing reserves, we need the oil pumping. So things around conversion of PPLs to PMLs, which we would see, hopefully quite a number of them, as we've seen maybe the start last week. Once we can see the conversion from PPL to PMLs, then we would also see, apart from increased reserve, which the FDP would guarantee, would also be seeing production, which ultimately would lead to revenue on the part of government through royalties and taxes, and also increased export earnings by the Nigerian government.
Yeah, but from your experience, in terms of the timelines here, how quickly can we expect these projects to translate into actual output?
Well, so like I said, these are FDPs. It takes a bit of time. Sometimes some of the FDPs or actualization of some of the terms of the FDP may take about 18 months to 3 years, depending on the plan by each operator. But I think the good thing is that if you have commitment, right, and the regulator is also creating the business environment to ensure that those commitments or those funding commitments with regards to development of the assets are achieved, 18 months to 3 years, we would be talking about increased production and definitely increased reserve.
No doubt, regulatory certainty will definitely do a whole lot to move the needle there. But let's get into the other part of the story here, where we're looking at the Nigeria LNG, and we're seeing that more or less they're shifting now to third-party suppliers, as we're seeing that the utilization is dropping. For you, what are the risks on one hand? And also, what are the opportunities this shift creates for the industry here in Nigeria?
Okay, if you recall earlier this year, there were media reports that the NLNG to the potential of the possibility of the NLNG defaulting in some of its sale contracts with its counterparties with regards to the sale of liquefied natural gas and the export of liquefied natural gas to counterparties. And obviously, the reason for this had been that there's been a deficiency in the feed gas, and the NLNG had to find a way to ensure that gas continues to get supplied to it for it to process and for it to ultimately export. Now, what may have caused the deficiency in the supply of feed gas, as you may know, may not be unconnected with the fact that we had a situation whereby some of the shareholders in the Nigerian liquefied natural gas companies decided to divest in some of their onshore assets. And obviously, when there are new owners, obviously, the new owners may have another direction with regards to gas utilization, and the NLNG did not have what I'll call control over the supply of feed gas. But in August, if you recall, in August, there was announcements that the NLNG had gas supply agreements, 20-year gas supply agreements with 6 gas producers. And I guess that is the step in trying to cure the supply deficiencies. And the interesting thing is that out of the 6, I think about maybe 50 to 60% or includes JVs in which indigenous companies are part of. So essentially, what the NLNG has done is to stabilize its supply in order to ensure that it doesn't default with regards to its counterparty contracts, which is a good thing, both for the shareholders of NLNG and also Nigeria, considering that Nigeria is a shareholder. The NNPC is a shareholder in the NLNG. So essentially, dividends from the NLNG obviously is quite important to the Nigerian government with regards to funding of some of the government's obligation.
Yeah, but in terms of the domestic capacity for gas, we're seeing that, yes, the IOCs have been retreating from these onshore operations here. You know, how does this reshape the dynamics here for domestic gas supply landscape here in Nigeria?
Well, so in terms of the gas supply generally, before we even talk about gas, domestic gas supply, irrespective of the shift by the divestment, do not forget that the likes of Renaissance has indicated their their commitment to continue to invest in gas. So you would find a situation whereby, in as much as we have new owners into the divested assets, there's a commitment to invest in gas. Now, how does this play out from a domestic market supply perspective? There are definitely domestic gas supply obligations which producers must comply with. But one thing we should also bear in mind is the issue of pricing. Pricing continues. There continues to be an issue with regards to ensuring that there's competitive pricing to encourage domestic supply. Obviously, there is still the competition between domestic supply and international supply. But I think if issues around pricing are looked at critically and there's encouragement of ensuring that even domestic pricing is also quite competitive and profitable to producers, then we shouldn't have any challenges.
All right, the price is still a major factor there, but thank you so much for your time on the show today, Oyeyemi Okede, a partner at AO2 Law.